Friends, welcome back. Today we are going to discuss about how an early investor aged between 20 and 30 years should select mutual funds in India with a long-term investment horizon like 20 or 30 years, monthly systematic investment. Example portfolio structure is given below. This percentage can be changed based on risk appetite. This illustration is for informational purpose only. Talk to financial advisor for your specific requirements. 60% HDFC Flexi Cap Growth Fund, 30% HDFC Mid Cap Opportunities Direct Growth, 10% HDFC Balanced Advantage Growth OR Gov Tax Free, 7.5% Bond or Bank 5 years FD for a person living in India aiming for retirement in 20 years. A two-fund portfolio strategy focusing on high-risk funds can be highly effective. This approach emphasizes broad diversification and active management, which historically tend to outperform over the long term. Here's a breakdown of the two funds and considerations for an Indian investor. Core principles of the three-fund portfolio: simplicity, easy to understand and manage. Diversification provides exposure to various asset classes and market segments. The three funds for an Indian retirement portfolio. Given a 20-year horizon, you have a good amount of time to take on some equity risk for growth while also incorporating a balanced fund for stability. Indian Equity Market Flexi Cap Fund. Purpose: to capture the growth of the Indian economy. Large cap companies tend to be more stable and represent a significant portion of the overall market. To gain exposure to the broader Indian equity market beyond just the largest companies. This can provide additional diversification and potentially higher growth, albeit with higher volatility. Recommendation: A HDFC Flexi Cap Growth Fund. Why direct plan? Always opt for direct plans, as they have lower expense ratios compared to regular plans. Indian Equity Market Index Fund. Purpose: to gain exposure to the broader Indian equity market beyond just the largest companies. This can provide additional diversification and potentially higher growth, albeit with higher volatility. Recommendation: A HDFC Mid-Cap Opportunities Direct Growth Fund, Indian Equity Market Balanced Fund. Purpose: to balance market higher volatility. One fund which balances should be considered. Recommendation: A HDFC Balanced Advantage Growth. Why direct plan? Always opt for direct plans, as they have lower expense ratios compared to regular plans. Govt bonds or FD. Purpose: to provide stability, reduce overall portfolio volatility, and generate some income. As you approach retirement, the allocation to this fund will likely increase. Considerations: FDS. These fixed deposits in banks or government securities funds. These invest in government bonds, which have minimal credit risk. Asset allocation for a 20-year horizon. For a 20-year horizon, you can generally afford a higher allocation to equities for growth. A common starting point for a young or middle-aged investor is an equity-heavy portfolio. A reasonable starting allocation could be Indian Equity Market Flexi Cap Fund, 60 to 70%, Indian Equity Market Index Fund, 30 to 20%, Indian Equity Market Balanced Fund, 10 to 10%. Govt bonds or FD. Example portfolio structure: 60%. HDFC Flexi Cap Growth Fund, 30%. HDFC Mid-Cap Opportunities Direct Growth, 10%. HDFC Balanced Advantage Growth OR Gov Tax Free, 7.5% Bond, Bank 5 years FD analysis of past performance for an individual who has started systematic investment of 10,000 per month from June 2005. An illustration. Let's assume a 20-year-old investor earning 2 OK per month in June 2005 started investing in 2 funds with monthly SIP of 5,000 each. He is trying to save 50% of this take-home pay during his early age. For 20 years, he has invested 24 lakh rupees in total so far. The current value of his portfolio is 1.61 crore. Rupees 17.3% returns from these systematic investments. He did not do any step up of his monthly investments as his salary keeps increasing. This is one way of higher saving at the start. Let's assume if he steps up his investing every 5 years by another 1 OK rupees. His monthly SIP would be 1 OK in total for initial 5 years from June 2005. Then from 2010, it would be in total 20K rupees monthly he has to save. Then from 2015 in total 30,000 per month savings. Then from 2020, he has to invest in total 40K rupees per month in savings. So after 20 years, he has invested 60 lakh rupees in total, and it has grown to 2.86 crore rupees, which is around 17.6% returns. This is past performance. This may not be guaranteed in future, but this analysis gives us a picture how an investment can grow. Also, direct plans were not available, so he has chosen regular plan initially. Now each investor should plan to use direct funds to save on fees. Important considerations for Indian investors. Risk tolerance. This allocation is aggressive and assumes a moderate to high risk tolerance. If you are risk averse, you might increase your debt allocation. Rebalancing. It's crucial to rebalance your portfolio annually or semi-annually. This means adjusting your holdings back to your target percentages. For example, if equities have performed well and now make up a larger portion of your portfolio, you would sell some equity funds and buy more debt funds to return to your desired allocation. Direct plans. Always choose direct plans when investing in mutual funds to save on distributor commissions, which can be significant over 20 years. Expense ratios. Look for funds with the lowest possible expense ratios, especially for index funds, where the goal is to simply track the market. Taxation. Equity funds. Long-term capital gains on equity mutual funds are taxed at 10% on gains exceeding 1 lakh in a financial year. Short-term capital gains are taxed at 15%. Debt funds. Capital gains on debt funds are taxed based on your income tax slab if held for less than 3 years. If held for more than 3 years, they are taxed at 20% with indexation benefits. Dividend distribution tax. Dividends from equity funds are taxable in the hands of the investor at their applicable slab rates. Regular investing. Consistently investing through systematic investment plans is highly recommended. This allows you to rupee cost average and mitigate market volatility. Emergency fund. Before investing for retirement, ensure you have a robust emergency fund in a liquid and easily accessible account. Professional advice. While this provides a general framework, it's always advisable to consult with a SEBI-registered financial advisor who can assess your individual financial situation, risk tolerance, and goals to create a personalized retirement plan. This 3-fund portfolio approach provides a solid, diversified, and low-cost foundation for long-term wealth creation for retirement in India. Thanks for watching. Please like and subscribe. See you soon with another interesting video.